Have you ever wondered what capitulation means in financial terms? Well, it's not about waving a white flag on a battlefield, but it does involve surrendering. Capitulation, in the world of finance, refers to the act of giving up resistance in the face of overwhelming market conditions. Imagine a scenario where the prices of financial assets are declining sharply and continuously. Investors, faced with this situation, may decide to sell their holdings in a panic, leading to a further decline in prices. This is what we call capitulation, a word derived from the Latin capitulum, meaning a chapter or a heading. In this context, it signifies the closing of a chapter or the surrendering of positions by investors. One of the key characteristics of capitulation is emotional selling. The decision to sell is driven by fear, panic, and a desire to exit the market to avoid further losses. Investors who capitulate often act impulsively, their actions based more on emotion than on a rational assessment of the inherent value of their investments. Another defining feature of capitulation is high-volume selling. During a capitulation event, there's typically a surge in trading volume as a large number of investors rush to sell their assets. This high-volume selling is indicative of the widespread and intense pressure to sell. Now, capitulation is often seen as a potential signal of a market bottom. After a wave of capitulation, some analysts and investors believe that the market may have reached a point of extreme pessimism, setting the stage for a potential reversal in prices. To identify capitulation, traders and analysts use various indicators such as spikes in trading volume, extreme readings in sentiment indicators, or rapid declines in price that exceed historical norms. On the flip side, some investors view capitulation as an opportunity for contrarian investing. They consider buying assets that have been sold off during the panic selling, on the belief that once the emotional selling subsides, there may be potential for a rebound in prices. However, it's crucial to remember that while capitulation can be a signal of a potential market bottom, it is not foolproof. Markets can continue to experience volatility and further declines. Thus, investors should exercise caution and conduct thorough analysis before making investment decisions based on market sentiment. So in summary, capitulation is an emotional response to overwhelming market conditions, characterized by high-volume selling and often seen as a potential signal of a market bottom. While it can present opportunities for contrarian investing, it should be approached with caution, as it is not a foolproof indicator of market trends.